Welcome to Mukesh Manoharan Studio. Please subscribe to my YouTube channel and press the bell icon before we proceed. We all know that quiet, persistent ache of watching our hard-earned savings slowly lose their strength to inflation. And when you look toward the stock market as a way out, as a way to protect what you've built, it just looks like a giant, impenetrable wall of numbers, flashing charts, and endless stress. It can be incredibly intimidating. But today, we are cutting through all of that noise. We are going on a journey together to uncover the ultimate beginner's blueprint for Indian mutual fund investing.
You've undoubtedly seen the billboards towering over the streets. You've heard that catchy, familiar slogan echoing on your television. Mutual funds sahi hai. Mutual funds are right for you. But what does that actually mean when the screen fades to black? It's a fantastic piece of marketing. But if you're like most people, you are left wondering if it's just empty hype or a genuinely effective financial strategy to secure your family's future. Well, stay close because we are going to completely demystify this entire world today. To get there, we are going to follow a clear, illuminated path. We'll explore exactly what these funds are, uncover why they might just be the best choice you can make, and walk through exactly how you can take your very first steps to start investing. We'll also take a deep, honest look at the real risks and realistic returns before finishing our journey with some golden rules designed specifically for beginners. So let us begin with our very first real question. What exactly are mutual funds? Let's explore this core concept together. Think of a mutual fund exactly like a massive, calm swimming pool. But instead of water, it is filled with money collected from thousands of different individuals, people just like you dreaming of a better tomorrow. And instead of you having to frantically figure out which individual stocks to buy or sell, which, let's be honest, is practically a full-time job, this vast pool is handed over to a professional fund manager. These are seasoned, deeply experienced experts whose entire purpose, day in and day out, is to carefully nurture and grow that pool of money by investing it with precision. Imagine the seamless journey of your money. First, you make the decision to invest. Second, your contribution is beautifully combined or pooled with everyone else's. Third, that professional manager confidently takes the wheel. And fourth, they deploy that massive pool of capital into a diverse landscape of assets, things like stocks, bonds, or a strategic mix of both. You are essentially hiring a master of the craft to carry the heavy burden for you. This brings us to a profound shift in the financial landscape. Why choose mutual funds? Because this is truly about the democratization of investing. This is the moment the heavy gates of wealth creation are finally opened for everyday earners and middle-class savers. 500 rupees. Think about that for a moment. If you tried to build a well-diversified stock portfolio completely on your own, you would need a staggering amount of capital just to buy one single share of some of the world's most powerful companies. But here, you can start a systematic investment plan known as an SIP for as little as 500 rupees a month. It completely shatters the barrier to entry. And your 500 rupees unlocks something incredibly powerful. You get that expert professional management we just talked about, but the true magic here is instant diversification. Because your money is pooled, you instantly own tiny, fractional pieces of dozens of successful companies right from day one. If one single company struggles, the others are there to hold you up, significantly buffering your risk. Combine this with the sheer convenience of tracking everything entirely online, and you have built a relentless engine for long-term wealth creation. And as we continue to uncover these secrets, if you are finding value in our journey today, please take a brief moment to like this video, share it with someone you care about, and make sure you are subscribed to the channel. It truly helps us bring these stories to you. Now that you see the potential, the natural question is how? Let's walk through the actionable steps for making your very first investment. The very first step is simple. Complete your KYC, which stands for Know Your Customer, using your PAN card, Aadhaar, and bank details. You can easily do this on any trusted investment platform. Once you are set up, the secret is matching your personal life goals to the correct fund. Dreaming of a distant retirement or building a house a decade from now, equity funds are your vehicle for that long-term, aggressive growth. Need a safe harbor to park a short-term emergency fund? Debt funds offer you quiet stability with lower risk. Searching for a comfortable middle ground? Hybrid funds beautifully balance the two. And if you simply want to track the vast rhythm of the whole market at a very low cost, index funds are waiting for you. But as we step deeper into this world, we must have a calm, honest conversation about risks and realistic returns. Setting the right expectations right now is absolutely vital. Here is the truth you must hold on to. In the market, returns are never strictly guaranteed. However, when we look back through history, we see that over long, patient investment periods, equity mutual funds have often delivered in the powerful range of 10 to 15% annually. Just remember, actual returns will ebb and flow with the market's tide. On the other side, debt funds will generally offer lower returns, but they wrap your money in a protective layer of much lower volatility. You have to look at the full, balanced picture. Yes, these funds are incredibly easy to start. They offer high liquidity so you can access your money when life happens, and they give you a fighting chance to beat the silent thief of inflation. But you must accept the shadows too. The lack of absolute guarantees, the unavoidable market fluctuations, and the expense ratios you will pay. The greatest danger in all of this? Panic. Selling your investments during a frightening market crash turns temporary, invisible paper losses into permanent, devastating, real losses. To protect you from those moments of panic, we need to talk about our final, most important lessons. These are the top tips for beginners, the golden rules of wealth creation. Carry these truths with you. First, always align your investments with your heart's true financial goals. Second, choose the quiet discipline of an SIP over the frantic gamble of timing the market. Third, build a fortress, a solid emergency fund before you ever dive into market investments. Fourth, if you are in equity, patience is your greatest weapon. Be prepared to stay invested for a minimum of 5 to 10 years. Fifth, for the sake of your own peace, do not obsessively check your portfolio every single day. And finally, drown out the noise. Ignore the social media hype. Before we reach our journey's end, just another gentle reminder to subscribe to the channel so we can continue sharing these vital stories with you. Let us part ways today with a profound piece of wisdom. Start early, invest regularly, stay invested, and let compounding work for you. The true magic of this world isn't about getting rich overnight. It is the quiet, unbreakable mathematical power of compounding over decades that turns small, disciplined, everyday habits into serious, life-changing wealth. It is about taking control of the story of your life, starting right now. So I leave you with this one thought to carry into your day. What deeply personal financial dream are you going to start a 500 rupee SIP for today? Thank you for walking this path with me. I appreciate you being here.